Hi there, welcome to Market Call, our daily spectacular at this time on which a portfolio manager or other expert market observer takes your questions on stocks. Now today it's Jaime Carrasco of Canaccord Genuity. The topics are precious metals and North American dividend stocks. You can phone Jaime right now, 1-855-326-6266, or email us marketcall@bnnbloomberg.ca. Before we connect with Jaime, let's have a quick look at how the markets are trading now. Let's pull up the big North American indices because we did see happier times for the equity bulls today. Stocks rising after their drubbing last week. S&P up around 1%. Whether stocks were oversold last week, of course, time will tell, but you can see people moving back into equities right now. Jaime Carrasco joins us now. Precious metal stocks and North American dividend shares are on the menu. It's great to have you here, Jaime. How are you viewing these markets as we run in? I mean, I think I've heard a commentator saying the worst thing for certainty, I know, where do you begin? The worst thing for investor confidence will be a long, drawn-out dispute over who actually won the presidential election.
Well, thanks for having me back, especially on this starting cold period here in Collingwood. I think that it's important to understand that whomever wins the U.S. election going forward, it's really a binary effect. How much noise is left after, we don't know. It could be traumatic or it could be a smooth process. I think that'll depend on what level of voter turnout comes out. I think what's important, though, which the big picture that I've been concentrating on, that I keep talking about, is the monetary reset, that at some point something has to be done about the debts, and that's definitely being discussed now out of the IMF, the G20 meeting that's coming up. I think that's the bigger picture. Because what's important is whomever wins this election is going to be negotiating with the rest of the world as to the structure of that agreement. And the way I see it, there's two very definite roads on that. If Joe Biden wins, well, we know that it's going to be more of a global structure in terms of whatever reset is done to deal with the debts. If Trump wins, it's going to be more along the lines of Hoover back in the 30s, where the U.S. becomes more isolationist and retrenches. And I think no matter what, gold wins within both scenarios, because gold is the only constant that we can all use to reset debts. And historically, that's how it's been done. And that has always been my premise, that, you know, if we look at the global structure, something needs to be done along the way. It's been done before the Rome Accord, the Nixon in 71, you know, Roosevelt in 33. It's the only way to deal with debts at a global basis. And that's really what I've been preparing for. I think the election is just a lot of noise and consequence, of course, in terms of markets. How it plays out, I think we'll have to see over the next, it'll be definitely very interesting coming into year end, but I'm set up to hedge for greater volatility regardless.
When you say a fiscal reset, what do you mean?
Well, let's look at what happened in 1933, because that's a really good time, or in 1971 with Nixon. In order to deal with the debts, governments never default. What they do is that they revalue the currency under which those debts are issued under. So that way, they don't say that they defaulted. All they do is they unwind the value of those debts. The problem is twofold. One is if you are holding that debt, the cash flow you were expecting from that debt is going to revalue or be much less than you were expecting, which will be a very big consequence for pension funds that are sitting on that debt. I was looking at a report that the bulk of U.S. debt is owned by foreigners, so foreigners would be on the hook. Furthermore, a lot of the foreign currencies are tied to the U.S. dollar. So if Trump wins and he decides to, you know, well, if we're going to reset this, we might as well devalue the dollar, there's going to be a lot of problems within that. And I think revaluing the dollar has to be done within all within the global structure, because that is the problem, is that we have way too much debt. So what they usually do is take the value of all that debt and revalue it, not in in that I'm not going to pay you back your $1,000, but the $1,000 that I owe you is going to be worth 1/10 or whatever the amount is of the money that I owed you before. That's what happened in 75. When Nixon, or in 71, when Nixon unpegs from gold from the dollar and we go into a fiat system, what happens next is not that gold ran up to $800, is that the value of the dollar, the purchasing power of the dollar, declined by that amount. Same thing in 1933. It's not that gold ran from 7 to 35. It's that the value of the debts in sterling at that point, because the sterling was the currency reserve, and the dollar devalued by that amount. So look at it more in terms of a debt to equity equation, where on a global basis the only asset is gold. So by revaluing the asset side of the equation, you devalue the debt side of the ledger. It's that simple. Right, but people, and it's the only way forward, because how are we going to pay back for all of these liabilities? I assure you that if Trump wins, he's going to say, well, forget the world, we're just going to revalue, and it works to his benefit, because for MAGA, to make America great again, he has to kill the cost of labor in order to really bring manufacturing. So I think it solves with a Trump win, that happens much quicker. With a Biden wins, I think we're looking at a readjustment more like James Rickers was talking about, a basket set by the IMF called the SDR, the special drawing rights, whereby the U.S. is a component of that, but so is China.
Same effect. Let's leave it there, Jaime, because I know loads of people want to call in. Fascinating stuff, though, and we'll hear more about gold from Jaime Carrasco of Canaccord Genuity. He's taking your questions on precious metals and North American dividend stocks. Jaime was on our show November 20th of last year. His first idea was Sandstorm Gold, a return of 8%. It looks like this one's been a laggard in the gold space, Jaime.
It has been more because it's a royalty company, right? So it's not necessarily a producer. Royalty companies fall within that foundation of your portfolio, where you're going to have your producers and also your royalty companies. What do we expect from those guys is more asset growth, in that the value of the assets that they have funded. Let me back up. What is a royalty company? A royalty company goes to an Agnico Eagle, for example, and they help them finish financing and building a mine of all the different projects that they have. Once that mine is up and running, they take in the cash flow right off the top, 3 or 5% depending on the deal. That cash flow comes back to shareholders, plus the value of whatever resource they control within that project. So as those grow in value, the companies will grow, and so will the cash flow. And that's why you have them, because eventually you start seeing more and more cash flow. As far as Sandstorm, they continue to do their share buybacks. They have quite a bit of cash flow. They're great value at this current price. And I still like the stock. I still hold it. And we have it as just quickly, $13 target, but we do have it as a hold. I hold it. I haven't sold, and I just continue to trim back.
Agnico Eagle Mines. Would you buy this one again?
Of course. That continues to be part of the mainstay, right down from $22 back in 2015 until today. They just increased their dividend. I think it was 60% or 70%. It was huge, and that'll continue. Great formula in terms of profitability to dividend increases going forward. They have the leverage. They have a lot of projects coming in and mines around the world, including Kittilä in Finland, which I really like. Agnico, just 1 second in terms of the we can go to the next one in the meantime, but we do have it as a buy with a $120 target.
Okay. Yeah, as you say, Agnico just hiked the dividend 75%. Yep.
It was okay.
And then finally, your final idea: Harvest Equal Weight Global Utilities ETF, HUTL. Would you buy this one again?
Yes, I would. Now, keep in mind that I bought that's within my equity income portfolio, the portfolio I've set up for older people that require cash flow and capital preservation. Within that's where those infrastructure companies do well. They have a dividend. However, keep in mind that I have underweight my current position in all of those blue chip companies. Right now, they're underweight by about 30% of what I would usually hold, and I'm holding cash, and I'm waiting to buy more later and see how the volatility goes through. That portfolio itself has 30% in precious metals. And that's what's delivering the growth right now, because over the last year and a half, that allocation has really benefited it's protecting the assets while we wait to add more. And the dividends are coming in from Agnico is actually in that portfolio, and the dividend continues to grow.
We're showing this utilities ETF down over the period. Why was that?
I think it's more a reflection of the market itself. You know, if you look at the NAV, NAV has come down, and it's just part of the volatility of what we're living with. The way that I look at it, though, by underweighting and holding it, is the fact that the dividend gets fatter and fatter. So at some point I'm going to add to it, and I'm hoping that I add at a much cheaper price. Go back to 2008. At the beginning of 2008, Enbridge had about a 3% dividend yield. By the end of 2008, it had a 9.5% dividend yield. That's why I'm sitting on cash waiting for better entry points. Will we get them? I'm not sure. But for now, I'm happy to wait because I'm hedged on the other side within the portfolio.
No problem. We are going to take a break. Jaime Carrasco of Canaccord Genuity taking your questions on precious metals and North American dividend stocks. Your first idea, Jaime, Kirkland Lake.
Yes. What I wanted to do with the ideas was go back into structure of a portfolio. And that's why I chose Kirkland Lake, because Kirkland Lake, Agnico, they are the mainstay of my producer strategy. I continue to hold them. I continue to maintain them because I like what's happening. First of all, we have an asset that is still fairly cheap in relation to the current price of gold. They continue to add ounces on the ground through exploration. The cost of production is low. It has great management, and it's in geopolitically places in the world where I don't have to lose sleep over. We have it with an $80 target and a buy at Canaccord, and it continues to be part of my portfolio.
Okay, and yeah, I mean, that one's done well for investors, to put it mildly. You have a silver play here in Latin America, Bear Creek Mining.
Bear Creek. I chose that one just to highlight another component of the portfolio, which is producer developers. What I like about Bear Creek, they're building a new mine in Peru. So we have growth in production, a nice uptick plus exploration, and it's silver, right? Within Peru, I've just trimmed that back in order to buy another Peruvian play at an even cheaper valuation that we're in the process of closing now. But Bear Creek continues to be part of the portfolio, in addition to this new one that's coming in. And it also diversifies me out of Mexico. One of the issues with silver is that everything's in Mexico. That's where 80% of the production's coming out of. I think Peru, Argentina, Bolivia deserve some merit in terms of looking for other silver production going forward. Bear Creek, we have it with bear with me 1 second, please. $6, and we do have it as a speculative buy. It's a little bit smaller and more volatile. So be aware of that as you're coming down the risk spectrum, going up the risk spectrum, you're going to get more volatility within the prices.
And sorry, just remind us, where are they at now? Are they actually close to building a mine, or are they in construction?
They're in construction. So they have it's one of the most underdeveloped silver projects. They're working within the feasibility study, and they're getting everything up and running and getting it started.
Okay.
So they're in development.
Finally, in development, no problem. So they haven't started actually construction. New Legacy Gold, NUG, on the venture. Tell us, so they're working in Nevada on the Carlin trend?
Correct. Now, Again, this is one of the speculative plays. This is strictly exploration. If the drill bit works, this thing will go. So it's not one that you want to own on its own. It's speculative money. It's not investment money. It's strictly speculation because if the drill results come in, it's going to be great. Now, what we have here is good management. So a lot of the Barrick X management is moving over here. They are sitting in a great geography where in the U.S. we have found some of the best mines over the last 20 years. Their neighbors have been finding quite a bit of gold as well, and one of them just did a royalty with Metalla. Metalla looked at the work of the neighbor, and the geological symmetry is almost there. It's very close to what they have, and now we're going to start to see some drill results coming forward, and I'm pretty optimistic that when you look at geography, you look at geology, there's a lot of, the odds are quite good that they also have what the neighbors have. But again, I want to reemphasize that when looking at exploration plays, be it, of your overall gold strategy, make sure it's no more 10 to 15%, and within that you have at least 5 to 6 plays, and choose them well as you move forward. We discussed a number today, Fosterville, Orion, and this one as well. This one we have it as a speculative buy with a 25-cent target, and we will be getting drill results because the rigs are turning. They've raised money over the last while, and the work is being done within this.
Okay, we better leave it there. Jaime, always great talking to you. Haven't had you on Market Call for too long, and I hope you come back soon.
It's always a pleasure. Thanks for inviting me back.
Jaime Carrasco of Canaccord Genuity. Well,